You're taking a look at a live shot of the opening bells on Wall Street. I'm Yahoo Finance Executive Editor Brian Sozzi, and this is Opening Bid. Here on Opening Bid, we bring you the investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make decisions with your money. Let's get down to the NASDAQ in Times Square. That's where we find Yahoo Finance's Ali Canal, who I know is watching the bubbly move in Nvidia. But first, a look at the major averages. Ali.
Hi there, Brian. Yeah, all three indexes set to open in the green today. And this comes as the S&P 500 is in striking distance to its record high. We'll see if these gains can hold throughout the trading session. We just missed it yesterday, so I'm hoping for a record close today. And speaking of records, you just talked about Nvidia. We saw a record close last night, and then that company is set to open at a record this morning here. Taking a look at shares, they are up about 1% heading into the opening bell here. The valuation, that's been a big topic among Wall Street strategists. We are currently at a market cap of around 3.7 trillion, but some on Wall Street say we could potentially see 6 trillion for this company, for this stock. And the strategists and sources that I've been speaking with tell me that Nvidia might be undervalued at this point, considering the growth potential down the line. So all eyes are on tech, and certainly, as always, all eyes are on Nvidia.
Ali, why not 10 trillion? I mean, Nvidia hasn't even hit 4 trillion market cap yet. That is absolutely fascinating. I also know you're watching Circle.
Yeah, Circle saw a significant pop after its IPO, but we have seen a bit of a bumpy ride since then. I believe we are opening in the green here. Let me just check on this stock. Actually, we were down 10% yesterday. Now we're higher. 4.5% at this point is the open, trading just around $208 a share. And that's the hard part about IPOs here, Brian, is there's usually a lot of volatility in the days that follow. However, when you have a company that over, the past month or so since it's open, we see a significant move to the upside, although over the past 5 days here, we are up just a more modest 4%.
Circle, closing the loop, Ali. Hey, I'm here all day with the jokes. I'm here all day. I'll see you in a minute. All right, appreciate it, Ali. All right, we're kicking things off with your daily guide to the biggest market drivers of the trading day. Here's what I'm locked in on. Number one, President Trump is so frustrated with Fed Chair Jerome Powell's slow approach to rate cuts that he's looking to name his successor early, according to the Wall Street Journal. This has investors curious on what a shadow Fed chair may mean to stocks. Number two, Goldman Sachs is flat out calling the potential for a stagflationary shock to markets later this year. And number three, Nvidia's bubbly move up the Yahoo Finance stock charts rages on. The stock opening to a fresh record high after a tough start to the year. What does this mean for the AI trade and all the Nvidia bulls out there? Here to break it all down right now, FedWatch Advisors founder and chief investment officer Ben Amons, and Yahoo Finance's Ali Canal is still here, and Inez Ferre making her debut on Opening Bid. Good to see you all. Ben, I'm going to hit you up first because you are our resident Fed watcher here. What exactly would a shadow Fed chair, first of all, what is it, and have we seen it before in the history of the Fed?
The shadow Fed chair, Brian, is someone who basically takes the position of the chair and communicates quite openly about policy, what she or he thinks policy should be at and go forward from here, without actually having the voting authority on the FOMC. And yet people will pay attention to this person because, as it is the incoming chair, it already is shaping our policy where it will be in the future, and markets are always about discounting the future, right? So that's, I think, what the shadow Fed chair could do, really affect expectations.
Ben, let me get in here real quick, Ben. Who should investors listen to? A month from now, let's say we get Christopher Waller. I mean, who should that long-only investor listen to? Things that Jerome Powell says as he winds down, the last 8, 9, 10, 11 months of his term, or Christopher Waller, who might be out there doing an interview somewhere suggesting we need rate cuts?
The market's already listening to Chris Waller, Brian. I mean, they basically start pricing in this rate cut a bit sooner than what was before, partly because of his comments. And people pay more attention likely to Chris than to Jerome Powell, for that matter, knowing he's going to be out. The moment you announce this new candidate, that's exactly the process that will start playing out in the markets. It will take the shadow chair more seriously than the current chair, for that matter, in terms of future policy. But has this happened before in Fed history? Well, take Alan Greenspan. He came out of the administration. He was sort of pre-announced initially. But that was a different time. So I think this is quite unique what we're dealing with here in terms of then where we go from here. Nonetheless, we're going to see a new chair in the future. So policy will shape itself that way. And if inflation continues to moderate, the market will continue to price in deeper rate cuts.
Ben, I still remember those Alan Greenspan testimonies. Had no
Yes.
clue what the hell the guy was even talking about. He just sounded really smart. Inez, let me get over to you because I know you're watching oil, various commodities. You're also locked in on all things crypto. Ben made a really good point that perhaps this market is already taking a cue from someone like a Christopher Waller, who's been out here recently suggesting we need rate cuts. I even look at the move in palladium. These are metals potentially moving in front of a more inflationary environment if we get rate cuts.
Yeah, that's right. The metals have been moving and gold has been moving. I mean, you have to look at what has happened in the market so far this year, and that is investors have flocked to gold. They have gone towards Bitcoin. They have gone towards other assets. And we have seen the Sell America trade earlier this year. Look, I will say one thing about this issue of whether Trump says who he wants as Fed chair early or not. There are some in the market that feel that when the whole tariff situation was going down, which, by the way, that's coming up again, that when that was happening, the fact that Powell remained steady actually helped the bond markets because we saw the 10-year rising and we saw the sort of issues that were starting to happen in the bond market. So the fact that Powell stayed steady, that there wasn't this influence that we've seen in emerging market style countries that we've seen in other countries. There are analysts that feel that it was a good move for him to stay steady. So it'll be interesting what happens if Trump does name who he wants as the next Fed chair early, to see what happens in the bond market as well and how the market reacts overall.
No, good point, Inez. I should also mention, too, that Wall Street Journal report mentions Kevin Walsh, who hasn't been in government for 15, 16 years, Christopher Waller, Fed Governor, Treasury Secretary Scott Bessent, and of course Kevin Hassett, a friend of or no stranger to Yahoo Finance. But Ali, you're watching markets quite closely. I mean, just picking up what Ben was saying, the markets. I always hate saying the markets feel. Markets feel nothing. They trade on numbers and various plumbing in the system. But still, this is a market that seems to be moving on the fact that we do get some rate cuts.
Right, and I do think if we see a cut, especially if we have some sort of a surprise cut in July, markets are going to react to that and we could see a pop. I've been thinking, though, what if we cut for bad news and not good news? Would we still see that type of reaction in stocks? And right now, markets are pricing in a rate cut in September. However, the odds of a July rate cut, that's edged up a little bit. Now, Jerome Powell, during his two-day testimony, he said that we would maybe consider a cut in July if the labor market deteriorates. I don't see that happening at this point. Continuing claims, continuing to edge higher today, but the unemployment rate is still solid. There is this sentiment among businesses that they don't want to fire at this point because past economic downturns, past recessions have taught us that it's really hard to rehire that talent back. So we're seeing businesses be steady right now. We're in this low hire, low fire environment. So as long as the economy holds up okay in the interim, I don't think we are going to see any type of rate cut in July, despite the president obviously wanting that at this point. But even after this Wall Street Journal report, markets not totally reacting here. I mean, we're seeing stocks edge higher today. There is this optimism overall in the markets right now. Tech is certainly leading the way higher there. So we'll just have to wait and see what ultimately comes out of this and who the president decides to go with.
And of course, that's a big anti-rate cut call, Ali, I think. I mean, if you get at me on social media at Brian Sozzi, you agree with Ali? I mean, I need to know what you're thinking. Are you in the rate cut or no rate cut camp? Ben, let me get over to you on the economy. This Goldman Sachs note out this morning calling for a potential second half, quote, stagflationary shock. Is that something you can get on board with? Do you see that happening?
It's always possible, Brian, because we have these underlying forces on inflation in the works. Brent, for example, the contract for Europe, that oil contract really broken out of the downtrend as the events around Iran played out. As much as we have a ceasefire and the negotiations maybe starting again, there's a lot of vulnerability, I think, in the oil market. And energy prices drive inflation first and foremost. And there's lots of talk and discussion about will tariffs be passed on, yes or no. you will see an effect from it. So to that extent, I think where Goldman is coming from, there may be some validity to it that we may see this move in inflation coming, as Powell was himself saying yesterday. But the true stagflation, not sure in terms of like high unemployment rates, partly because, as your colleague says, the economy is sort of holding in. It just may have to deal with a little bit higher inflation for the moment that could slow the economy. You could see it in GDP data today. It's a lag data, but it was negative on the last print sort of revision. I think it's really the effect a bit from the tariff uncertainty coming through that growth slows, but we're getting a little bit higher inflation. That's your stagflationary quote shock, maybe in the second half.
Well, Ben, let's just really go down the rabbit hole here. I mean, we're all in pretty good moods today. By no indication,
Yeah.
we haven't gotten any trade deals. What, we had one thing with the UK. We're coming up against that July 9th deadline. Why won't we see a recessionary shock?
Yeah, it could well be if you really go forward with these high tariffs after July 9th, you really draw the line on July 9th. Now, there too, a lot of noise about it, like they would probably do some extension for certain countries that keep negotiating with the administration in good faith, as I said. But it is a risk because these tariffs are going to be significantly higher. So it's going to be an impact one way or the other on growth. And I think that it may not put the recession scenario right at the door, Brian, but that risk is lingering there. And I think this is why the pressure is on the Fed too, that they have to move at some point with rate cuts, try to stave off that recession scenario.
And as you cover oil and the commodities markets for us very closely, what are you seeing most notably in oil? We're a little bit beyond the situation or the height of the situation with Iran and Israel, but with oil declining off the highs, is there anything you're seeing in there that would suggest we might get that Goldman stagflationary shock?
Only if the Middle East tensions were to reflare and significantly, because what all the analysts are saying as far as oil is concerned is that they're expecting Brent to be lower this by the end of the year. They're expecting it to be some are expecting it to be in the mid 60s. But of course, this is if you don't have flare-ups in the Middle East, if you don't have supply disruptions. A lot could happen, of course, between now and then. But we're seeing right now that oil is just under the levels that it was before the Israel-Iran war outbreak on June 13th. So really, it has all that risk premium has gone out of it, come out of the price, but there's still a lot of volatility in it. This is one of the most volatile trades that we've seen, obviously, this year. So it could be the case that if you do see oil prices going higher, yeah, that's going to also that's going to impact gasoline prices that will trickle down into the entire economy.
Ben, real quick, last word to you on this topic. Do you think we will see a more volatile summer for markets than is currently priced in?
It could be
I do.
because,
I think volatility.
Allie, you're in. You're in. Get in there, Allie. Get in there.
yeah.
I mean, yes, I think we will see a more volatile summer, especially considering, like you mentioned, Brian, we don't have all these trade deals at this point. So what are we going to hear from President Trump on that front? And if we don't see the deals trickle in as quickly as we want, if they're not it's not at the level that we want, what does that mean for stocks? And therefore, what does that mean for the tariff picture and the inflation picture?
I'm liking these big calls from Allie. These are big calls. I'm liking these Allie Canal big calls. Ben, feel free to jump in.
Yeah, I agree with Ali. Like the volatility is definitely there. You know, the VIX is not at a really low level, right? If it was complacent, it would be a sub 10. It's actually close to 20, and the VIX actually shows projection on higher VIX from here. People expect volatility to come back simply because we're in this era of this major policy macro flux that just doesn't seem to ease that easily, even though it gets de-escalated quickly. So that leads all to volatility. So expect more volatility from it.
If I had one of those flame emojis, I would put it right over you, Allie Canal. So you're going to get, I'm coming to you first on this tech bubble. You mentioned Nvidia at the top of the show. No, keep it coming. Simple question. Are we witnessing another tech bubble? Now, you and I have been here at Yahoo Finance for a good bit. We've seen various bubbles. Cannabis stocks, I think, fell into our tenure. We've seen it with various AI stocks. From your vantage point, are we witnessing another one?
Another hot take for you, Brian. No, I don't think we are. I think AI is going to lead to insane productivity. I don't think that's being accurately priced into this market, priced into these tech stocks. I've been speaking with a lot of Wall Street strategists this week, and they tell me that Nvidia is undervalued, that other Mag 7 names are fairly valued, that this market is not stretched at all, that valuations are actually kind of low at this point, and there's a lot of cash on the sidelines. A lot of folks have been repositioning their portfolios. They've been putting money into defensive sectors. They came into the year maybe a little bit overweight on some of those tech names, so they pulled back a little bit. But now at this point, with tech leading the way higher once again, there's this rational thinking among especially among retail investors, that maybe they should be a little more aggressive, a little more overweight on the tech trade, because there's just so much growth at this point. And with AI just continuing to rapidly expand with these earnings, I mean, let's be real. We're not at the levels maybe of Nvidia that we saw a few years ago, but these are still pretty insane numbers. And I think a lot of investors have just gotten used to that. And compared to other stocks out there, especially small cap stocks, these larger companies are just able to weather a lot of this volatility, able to weather a lot of these risks in a way that some of these other players just can't. So I'm bullish on tech, and I think we still have more room to run.
All right, well, I appreciate that. It's high-level analysis there, Ali. I'm going to go on the other side. I think we're seeing some bubbly activity. And Inez, I'm going to come to you on this one. Circle, are you kidding me? The move in the stock since its IPO early this year, I think I checked the Yahoo Finance charts yesterday. Stock is up like 800% since the IPO. What? I mean, that has to be bubble activity.
Yeah, so that IPO price was $31 a share, and you can take a look, it's at $213. Look, it depends on which analyst you talk to, because stable coins, this is huge. And it's going to, what the market is doing right now is it is, of course, pricing in all of this growth ahead of time. You do have an analyst that just came out with a neutral rating for Circle, just basically saying that all of this has been neutral. Yeah, a neutral, because talking about rising competition because of the Genius Act that's expected to be coming into law later this summer. That is going to increase the amount of entrants that you have in the stablecoin space. And we have seen deals happening. We have seen a lot of activity in that area. And so what he's saying is that you're going to have an increase of competition, and Circle is going to, face that eventually. But nonetheless, you do have price targets in the 200s for the stock. It's a 213 right now.
And of course, you can catch the sentiment on Circle on the Circle ticker page on Yahoo Finance. You can check all the ratings. We're going to have to leave it there, though. Ali Canal, big hot takes. Inez, big hot takes. Ben Eamons, always good to see you, man. Had a couple big takes of your own. Appreciate it. All right, we'll be back with more on Opening Bid with a special guest for our Power Players segment. That is the chairman of the Council of Economic Advisors, Stephen Myron. Looking forward to talking to him. We'll be right back. Now for today's Power Players segment, time is running out for senators to reach a deal on President Trump's tax plan. The president wants the big, beautiful bill on his desk before July 4th. As the deadline closes in, it's still not clear to markets what the bill's economic impact will be. The White House Council of Economic Advisors estimates growth from the new tax plan could slash up to $2.3 trillion from the deficit, but the Congressional Budget Office found the mega bill would add $2.4 trillion to the deficit over the next decade. Joining me now to explain that disparity is Stephen Myron, chair of the White House Council of Economic Advisors. Stephen, good to see you here. Let's start there. What do you attribute that huge disparity between your projections and the CBO's?
Good morning, and thanks for having me. Look, the issues with the Congressional Budget Office's score is that they're not designed to be a holistic view of the deficit. They're designed to play into very specific rules for passing legislation through what's called the reconciliation process in Congress, that you'll need a simple majority to pass rules instead of the filibuster-proof supermajority of 60 votes, right? That's a really sort of highly specialized and Byzantine process, and it's just a mistake to extrapolate from the CBO score to think that you're understanding what's going to happen to the deficit overall. There's a number of things that are not included in that score that will reduce the deficit. Let me go through some of them for you. First, better economic growth. The One Big Beautiful Bill contains numerous tax incentives for better economic growth. There's full expensing on investment, full expensing on equipment investment, on new factories, on R&D. There's things like no taxes on tips and overtime and Social Security. And these are targeted at segments of the population that are very responsive to incentives to work more. And these will get economic growth booming, right? In addition to keeping tax rates low and preserving the president's historic 2017 tax cuts. This economic growth creates more revenue because if there's more income, then there's more taxes that get paid into the government, and that brings the deficit down. But there's lots of other stuff that the CBO doesn't include also, things like tariff revenue, things like cuts from discretionary spending administratively, things like lower interest burdens because we're borrowing less because of these other things. And all of these combine to materially bring down deficits. We calculate that when you add all these things up, better economic growth leading to higher revenues, tariff revenue pouring in, less discretionary spending because of administrative cuts to waste, fraud, and abuse, and lower interest expenses, we calculate that when you add all these things up together, you get about $8.5 to $11 trillion of deficit reduction over the 10-year budget window.
Stephen, let me push back, because within this report, I believe you're projecting 4.9% economic growth. However, the tax rates are going to likely stay the same in this plan versus 2017. What do you say to those that are saying you're being too optimistic on the output potential of the economy?
Yeah, so that's actually not the growth projection. So that number, 4.6 to 4.9% GDP growth over a 4-year period relative to letting the tax cuts expire, mean that GDP will be about almost 5% higher at the end of 4 years than before. Now that works out to a point to a point and a quarter a year, right, of better GDP growth from this, which brings GDP growth into the high 2s range. As a result of the One Big Beautiful Bill and the other policies we've got going on. So it's not a correct reading of the paper to think that we're claiming there's going to be 5% GDP growth.
Okay, fair enough. Now, you mentioned tariffs, and I want to dig into that a little bit, because you have tariff revenue reducing the deficit by close to $3 trillion. Now, in the report, those estimates were as of a June 7th memo from the Office of Management and Budget. Now, with these tariff negotiations still going on, should investors still expect tariffs are a key plank of the U.S. economy over the next decade?
Yeah, so the Congressional Budget Office finally did something on tariffs where they said that, and it's not included in the score for the bill because tariffs aren't part of the bill, right? But the CBO finally did something on tariffs, and they found that tariffs would bring in about $2.8 trillion over a 10-year window. Plus, if you reduce interest expenses on top of that, it comes to about $3 trillion, right? Which more than pays for their static score of the bill. Now, those numbers are very similar to our internal estimates. Our internal estimates are maybe a hair higher than that, but not materially enough that it's worth splitting hairs over. You do make the point that negotiations are well underway and that countries are lining up to make concessions to the president so that he can secure trade deals, and that is very true. Now, while I do expect that many deals many frameworks will be announced in the next couple of weeks, running up to the July 9th deadline, and that we are in the process of making very good deals, I don't know that I think the tariff rates are going to go in aggregate materially below where they are now. And so, while I can imagine a few countries maybe making such aggressive concessions they convince the president to lower tariffs below 10%, I don't see that being necessarily the case across all countries. And I'm sure there are other countries that are just going to be stubborn and decide no, and then they'll have the Liberation Day tariff snap back up on them. So some tariff rates may go down a little bit, it's possible, but other tariff rates will go up a bit. And so in aggregate, I don't know that the overall level will change that much. Moreover, if tariff rates are coming down, it's because other countries are making concessions to open their markets to American products in order to achieve those lower tariff rates. Right? The president is using tariffs to negotiate reductions in non-tariff barriers so that American goods can enter foreign markets and that we have reciprocal and fair trade. If American goods are entering foreign markets, then we're selling more. There's more income. There's more corporate income. There's more personal income. And these both get taxed in the same way all other corporate and personal income do get taxed. And so revenue still goes up either way. You just substitute tariff revenue into normal tax revenue. Sure. But in either case, money pours into the federal government.
Stephen, you're making some good points here. Let me just follow up here with this one. Now, Treasury Secretary Scott Bessent said earlier this month it was, quote, highly likely that the president will push back the July 9th tariff date. Is that still the case?
So my expectation, and to be clear, like I'm not a trade negotiator. I'm not in the nuts and bolts and the weeds of all these negotiations. But my expectation would be that for countries that are negotiating in good faith and making progress, that rolling back the deadline makes sense. I mean, you don't blow up a deal that's in process and making really good, good faith, sincere, authentic progress by dropping a tariff bomb in it. You do that when you're at an impasse and you're not making any progress. And the president has shown successfully time and again that that's how things work. So when talks with the EU weren't going anywhere, the president threatened 50% tariffs. That immediately resolved the impasse, and then talks resumed and started making really good progress. And the president said, okay, no 50% tariffs, we'll stay at 10% because we think we're making progress towards a deal. And that was very, very encouraging. And so my expectation would be that if talks are making authentic, sincere, good faith progress and that they're really moving forward, then I don't see why rates would snap back higher aggressively. If they're not, then I could imagine they do snap back higher aggressively.
Stephen, the time that we have remaining with you, I'm sure you saw the Wall Street Journal report on potential Federal Reserve nominees to replace Jerome Powell. Help us understand, what is the risk to the economy if we do get this shadow Fed chairman set up? And then ultimately, who should investors take their cue from?
So, I don't know that I see, I don't know that I see risks to the economy from, what the administration does on this stuff. As you know, the Federal Reserve sets interest rates, and so the primary risks to the economy are from what's actually going on with interest rates, not from anything that we do or do not do on that front.
All right, we're going to leave it there for now. Appreciate you answering all these questions here. Of course, CEOs, a lot of leaders I talk to, Stephen, have a lot of questions about where the economy is going and on all things tariffs and, of course, the tax plan. Looking forward to staying in touch.
Thanks. Good to see you.
All right. Coming up, Yahoo Finance's Market Catalyst will bring you the analysis behind the biggest moves of the trading day. You won't want to miss it.